Okay, so this past quarter was, well, it was a real head-scratcher. On one hand, you had corporate profits just absolutely exploding, blowing past every single estimate. But on the other hand, you had all this macro chaos and uncertainty looming over everything. How can both of those things be true at the exact same time? Well, that's what we're going to unpack right here.
And this number, this is really the key to the whole story. 13.1%, that's the S&P 500's earnings growth year over year. Now, to put that in perspective, Wall Street analysts, they were hoping for maybe 7.9%. So yeah, this wasn't just a good quarter, it was an absolute blowout. And it's the fourth quarter in a row of double-digit growth. Just incredible.
So that begs the big question, right? With all the headwinds we hear about constantly, tariffs, uncertainty, you name it, how are these companies not just getting by, but absolutely crushing it? What is the secret sauce here? What's fueling this engine?
And here we have our answer. It's really all about one thing, AI. The single biggest story this quarter is that all that money, we're talking hundreds of billions of dollars, that's been poured into artificial intelligence over the last few years, it's not just a promise anymore. It is finally, and I mean definitively, paying off. You can see it on the revenue line.
And this isn't some happy accident. People are calling it the AI supercycle, and it's a pretty simple three-step process. It all starts with step one, just record-shattering spending on infrastructure. Step two, that spending meets this absolutely insatiable and sustainable demand for more computing power. And then comes the most important part, step three. You get a clear, massive, measurable return on that investment.
I mean, just look at these numbers. They're wild. Microsoft and Amazon each spent almost $35 billion, with a B, on capital expenditures. Google spent $24 billion. And remember, this isn't for a whole year. This is what they spent in just 3 months. The sheer scale of the bet on AI is just staggering.
So, did the bet pay off? Oh, you better believe it. Just check out the revenue growth for their cloud businesses. That's where they deliver all these AI services. Google Cloud revenue is up over 30%, and Microsoft's Azure up an incredible 38%. The return on investment here is just crystal clear. You can't argue with it.
But here's the catch. This incredible AI growth, it's having this massive, distorting effect on the market. It's not a rising tide lifts all boats situation, not at all. In fact, it's basically splitting the stock market right down the middle. And when I say a split, I mean a canyon. On one side, you've got the Magnificent Seven. You know, Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. Their earnings soared somewhere between 15 and 26%. And then you've got, well, everyone else. The other 493 companies in the S&P 500, their growth was a much, much quieter 4 to 6.7%.
And this concentration is totally warping the index. Think about this. Just 7 companies now make up over a third of the entire S&P 500's market value. So, when you hear that the market is doing well, what you're really hearing is that these 7 giants are having a great day.
And what's really fascinating, is that this split isn't just a Wall Street thing. We're seeing this exact same division play out on Main Street, with the American consumer being pulled in 2 different directions. Disney's earnings report is the perfect case study. Get this, attendance at their U.S. parks was actually down a little bit, but spending per guest was up 5%. So how does that happen? Well, they're raising prices like crazy, with some tickets now costing over $200. They're essentially pricing out a huge chunk of the middle class to get more money from fewer, wealthier visitors. It's working for now, sure, but the long-term risk is that you start to erode that brand loyalty that took generations to build.
So you've got companies trying to navigate this bizarre split reality. And just when you thought things couldn't get any more complicated, this new crisis sort of popped up at the end of the quarter. A big macroeconomic storm cloud that people are calling the data fog.
So what on earth is the data fog? Well, it's what happens when a government shutdown stops the collection of essential economic data. We're talking about the big ones, the inflation report, the jobs report, and this data isn't just delayed, it's lost. It's gone forever. This means the Federal Reserve, the people who set interest rates that affect your mortgage, your car loan, everything, they're forced to make these huge decisions, basically flying blind.
And this timeline just lays out how this mess happened. The shutdown kicks off October 1st, right when they're supposed to be collecting all this crucial data. It drags on for 43 days. And when it's all over, the White House confirms what everyone feared. The October inflation and jobs numbers, they're unrecoverable. I mean, you can't go back in time and find out what the price of milk was last month, right? The data's just gone.
And the market's reaction? It was swift and it was brutal.
This quote says it all. The moment investors realized the Fed was heading into its huge December meeting without its most important tools, they freaked out. They repriced the entire risk curve, which is just a fancy way of saying they started selling off everything, and it triggered a really sharp downturn.
But here's the real kicker. Even with this data fog and all this uncertainty, the market is still trading at incredibly expensive levels. The S&P 500's forward PE ratio is sitting at 22.7. That's way higher than the 5-year and 10-year averages. It's like the market is a tightrope walker, but there's no safety net. Everything is priced for absolute perfection with zero room for error.
And that really brings us to the final question we have to ask. The market is making two absolutely gigantic bets right now. Bet number one, the AI boom will just keep on rolling, driving these massive profits. Bet number two, the Fed can somehow navigate this data fog and stick a perfect soft landing for the economy. But what happens if any part of that script suddenly changes?